This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 254 was recorded on January 14th, 2021. I'm Erik Townsend. This episode is brought to you by Abax Technologies, pioneering the design of smarter markets that better meet the needs of both market participants and society as a whole. The U.S. dollar index is bouncing this week, but so far not by enough to negate the precipitous decline that we've seen since mid-October. Is this the beginning of a trend reversal to the upside, or just a dead cat bounce? Forest for the Trees founder Luke Gromen returns as this week's feature interview guest to answer that question and many more about where the dollar is headed and what that will mean for other markets. Then be sure to stay tuned for our Postgame segment, where we'll take a look under the hood and see what markets are doing with another of Patrick's signature chart decks.
And I'm Patrick Ceresna. Now, Erik, Treasury yields are usually the last item we cover in our weekly market wrap, but you wanted to start this week with Treasury, so why the change?
Well, the reason for the change, Patrick, is I think Treasury yields are kind of driving everything else this week. And here's how I see it. Clearly, Treasury yields have backed up considerably in the last couple of weeks. What's going on? Why is that? Well, I think it's all about the stimulus expectations, the spending expectations. President-elect Biden is expected to speak this evening, and different estimates suggest that he's going to announce anything between a 1 and 2 trillion with a T like tango dollar stimulus bill. So markets are saying, okay, $1 trillion of spending. Janet Yellen's Fed is going to have to issue $1 trillion of new government bonds in order to finance all of that deficit spending. That's a heck of a lot of treasuries that are going to be flooding the market. That has to drive the price down and the yield up. And certainly that is true, at least in the immediate sense. But I think that by itself leaves out any consideration of, okay, but what is the Fed going to do in terms of stepping in to make up for all of those extra treasuries by being the buyer of last resort in order to prevent yields from going too much further? Right now, what's going on is we are seeing the anticipation of that big treasury issuance pushing yields up on treasuries, particularly at the back end of the curve, and that's affecting all of the other markets. So that's the reason that I wanted to start there. And I think the big question is, okay, but what do you really expect is going to go on in the long term? And what I think is going to go on long term is there is going to be a huge balance sheet expansion by the Fed. The Fed will be the buyer of many of those $1 trillion of treasury bonds. And I don't think that yields are headed markedly higher anytime soon. Now, of course, if President-elect Biden were to also announce after the $2 trillion of stimulus or whatever the number is going to be, that his next agenda item is to, insist the Fed stop stepping in and we just have to be more accountable and pay for everything with taxes and revenue this time and throw out the MMTers, well, then obviously Treasury yields are headed to the moon. Frankly, I think the sun rising in the west tomorrow is a more likely scenario than that happening. And the much more likely scenario is the sun rises in the east and President Biden supports the MMT crowd in printing lots of money to pick up this big treasury issuance, and the central bank is the principal buyer, and yields don't really back up dramatically. Right now, what we're having is the shock effect, where yields do back up, and that's affecting everything else.
All right, well, let's move on to that S&P 500 because at least the last few days have been a bit of a trade range right around this 3,800 level on the SPOOs. What's your take on the markets here?
Well, I think part of the pause is coming from what's happening in treasuries. Of course, one of the reasons that you can justify such crazy high valuations is because bond yields are so low. And if bond yields are going up, and particularly if there's expectations that they're going to continue to go up, well, that really starts to make an asset allocation question of whether you can allocate more to bonds and perhaps less to stocks. I don't think it's going to make any big difference in the end. I think that what we're ultimately going to realize here is there's going to be lots of money printing, lots of support for both bond and stock prices, just as we've seen over the last few years. And I expect the S&P will probably continue its relentless grind higher on all of these stimulus expectations. But right now, I think the backup in Treasury yields is kind of causing a brief panic, which I don't think is going to last very long.
All right, well, let's move on to that U.S. dollar index because it's been more or less a week off of its worst levels, hovering around this 90 handle. What's your take here on the dollar?
Well, this bounce began from, as you know, a very key technical support range. And, this is really kind of Luke Gromen's specialty as our feature interview guest this week. So I don't want to steal too much of Luke's thunder. Let's save most of the dollar discussion for him. But my own focus is on absolute, not relative performance of the dollar. I don't really care that much about the dollar index, a measure of the dollar's relative performance compared to other treasuries. I think about loss of purchasing power, which to me, it's just inevitable. The dollar has to go down dramatically in coming years in terms of its purchasing power, and that's got to be good for things like gold in the long run. So that's how I see it. As far as how the dollar does relative to other currencies, frankly, I don't care that much. This is Luke's specialty. Let's save the rest for Luke in the feature interview.
All right, well, let's move on to crude oil, which just hasn't quit. I mean, once we got above 50, it's just been almost methodically crawling higher. We're on the February contract around 53.61 at the time of recording. What's your take here on oil?
Well, Patrick, of course, Art Berman predicted $65 this year in last week's episode. The very next day, Goldman Sachs came out with a call for $65. I'm assuming the Goldman team is listening to MacroVoices late on Thursday nights and issuing their research guidance accordingly. That or great minds think alike. I'm not sure which. They're actually saying by summer, though, not just by end of year. As far as where we stand, Patrick, for the last week and a half, 10 days in there somewhere, the front month WTI futures contract has never even gone below the 5-day moving average for one tick. Today was a big day. It traded below the 5-day moving average for all of about a couple of hours and then moved above and closed above. So, it looks like maybe we're starting to see the market finally maybe pause for a breath, but I don't think there's any reason to conclude that the uptrend is over, at least not yet. We haven't seen any closes below the short-term moving averages, which would be the sign of a trend reversal. Maybe we're getting a little closer to it. It does feel to me like we're due for some kind of a technical correction, but I think it'll be short-lived. I think that we're ultimately heading higher. My own favorite trade, as our longtime listeners know, is the Z1, Z2 time spread. Entered that trade at minus 320. It topped 280 this week, so that's a $6 move in a time spread is a really big move for a time spread, and I don't think it's done yet. I won't be surprised if we get to a $10 total move by the time this thing is over sometime in the summer. Inventory-wise this week, crude oil drawing down 3.2 million barrels, Cushing, Oklahoma drawing down 2 million barrels, but that was offset by big builds in finished products. Gasoline building 4.4 million barrels, distillates building 4.8 million barrels. U.S. production unchanged for yet another week at 11 million barrels flat. Tape action, there was a brief bounce higher on the drawdown news, but then the tape was kind of flat back and forth, up and down, and as we're speaking Thursday afternoon, we're just moving above the price level that we saw before the inventory data came out. It'll be interesting to see if we move back above the 200-week moving average, which appears to be what arrested the rally, at least temporarily. And if we can move back above that, get above the highs from a few days ago, maybe we just never have that technical correction and keep on charging towards $65. I think we're headed there eventually, but we are overdue for at least a correction. We'll see what happens.
All right, well, let's move on to gold because no sooner did we finish recording our episode last week. The day after, gold goes down $80 an ounce in a very rapid breakdown. What's your take here on gold?
Well, again, this is why I wanted to start with Treasury yields. I think it's all about the backup in the 10-year yield. And, of course, the cardinal rule of gold investing is that an increase in real interest rates that is adjusting the Treasury yield for inflation. That's the enemy of gold, because most institutional investors consider treasuries to be as safe, if not safer, than gold, which I don't agree with, but that's the way the industry thinks of it. And they're saying, hey, if I can get a real rate of return on treasuries that is significantly positive versus gold yielding nothing, boy, it's hard to stay in gold when I could switch to treasuries that give me a little bit of real yield. So real yield is really, really important to the gold market. What's happening, I think, is the treasury yields are backing up right now. To my thinking, it's just very short-sighted thinking that the gold market is saying, oh no, that means real yield is moving up. Bad news for gold. Time to dump the gold. Well, wait a minute. Why is the Treasury yield backing up? Because the government's about to spend $2 trillion in stimulus. You don't think that's going to be just a wee bit inflationary eventually, and that real yield isn't going to come back down? Remember, real yield is Treasury yield adjusted for inflation. So once you get inflation into the equation, it brings the real yield back down to negative again, and gold becomes favorable. So I don't think the market is really seeing the forest for the trees, to coincidentally quote the name of Luke Gromen's company. I think they're missing the fact that, yeah, sure, Treasury yields are backing up. Real yields right now, this instant, are backing up. But that's because we haven't felt the effects of all this yet. Once we see the Fed monetize most of this debt issuance, and we see all of that stimulus money start to lead to inflation in the real economy, I think it's really, really good for gold. But for now, the market's going the opposite direction, and I think it's until we see those real yields turn around again that we're spooked for the time being.
Well, this week's featured interview guest is Forest for the Trees founder, Luke Gromen. So, Erik, why did we invite Luke back on the show this week?
Well, Luke has been Mr. Dollar Decline, and I won't say dollar crash. Luke has never said that, but he's the guy who has for years said, look, we're headed toward a secular change where the U.S. dollar loses its reserve currency status, falls from favor the way the British pound sterling did, back after the end of the Second World War. And it's going to be a major change in the whole balance of power in the world. I've always felt that Luke would be proven right in that forecast in the end, but I used to tell him I thought he was early. Maybe his time has come, so I wanted to get an update and see how he sees this situation and what he makes of both the Treasury rates and the transmission to other asset classes.
Well, Erik's interview with Luke Gromen is coming up as MacroVoices continues right after this message from our sponsor.
This episode of MacroVoices was made possible by Abex Technologies, which also sponsors my new Smarter Markets podcast, which airs every Saturday morning and explores how the markets themselves could be redesigned to better serve market participants and society as a whole. My interview with former U.S. Ambassador to Singapore, Frank Lavin, is available now at smartermarketspod.com. My guest on Smarter Markets this coming Saturday will be Joss Schmidt, founder of the Neo Stock Exchange. We'll discuss how privatization of stock exchanges has led to unfair advantages for high-frequency traders on most exchanges, and why Joss saw the need to design a smarter stock market to level the playing field. But you won't get Smarter Markets on your MacroVoices feed. You have to separately subscribe to Smarter Markets in your podcast app in order to receive this new podcast. More information is available at smartermarketspod.com.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Forest for the Trees founder Luke Gromen. Luke, it's great to get you back on the show. You've been on my mind lately because I have been saying for I don't know how many years it's been now, I'm absolutely certain Luke Gromen will be proven right in the end. But I kind of thought in the beginning you were a little bit early. Maybe I guess you were, as history has proven out. Are we at the point where we have the so-called Luke Gromen moment where the U.S. dollar really does start a decline that's a one-way direction, beginning to lose reserve currency status? It's the beginning of the end kind of moment. And if so, I think a lot of people, including myself initially, had maybe misunderstood you on that. Some people thought you were predicting a dollar crash, and I really don't think you are. I think you're predicting more of a slow process. So how do you see this playing out, and where are we in the story at this point?
Sure. No, thanks for having me back on, Eric. It's great to be here, and Happy New Year, everybody. I think we are really getting into the process. I think COVID accelerated things meaningfully. We've been saying that we think that it's a process of a change in the structure of the dollar's reserve status, which effectively is the key hallmark of which is foreigners ceasing to grow their holdings of treasuries as the primary reserve asset in favor of gold in particular, but other sovereign bonds as well, basically balancing things out. And there was actually an article on Bloomberg this morning highlighting that for the first time ever, Russia's gold holdings in their FX reserves are higher than their dollar holdings. And the number one reserve asset they have in FX reserves is euros, followed by gold, followed by dollars, followed by yuan. And I think that's sort of where the world is moving, where it's if you can buy commodities and energy in particular in euros or yuan, which you absolutely can buy the marginal barrel of oil globally in either of those currencies. And that means the world needs structurally significantly less dollar reserves over time. And so I think where the world is going and where we continue to be in is this multi-currency energy pricing, multi-currency FX reserve system where gold takes share from the treasury bond as the world's primary reserve asset. And the flip side of that is since the world doesn't need to hold as many dollars and as many treasuries structurally, if they can buy energy in their own currency increasingly over time, then the flip side to that is because most countries, and in particular Europe, China, Japan, the big creditors of this entire system, their biggest deficits are in energy and in commodity imports. Then the flip side is they don't need to hold as many treasuries, and somebody else needs to finance U.S. government deficits, which are big and rising cyclically because of COVID and rising structurally because of demographics and the promises we've made to the baby boomers. And our case has long been that the marginal financier of U.S. deficits as this happens will have to be the Fed. And that's what's been happening. And I think it's going to continue happening. Now, what does that mean for the dollar in the near term? This, I think, is a different discussion. I think I wouldn't be surprised if we get a bit of a bounce here. I think the Fed is pretty concerned about what the dollar has done in the last 12 months or last 9 months. And I think they're a bit cornered, but I think some of what they could do might actually see a dollar bounce in the short run.
Luke, with respect to your outlook, obviously there's two aspects to this. One is dollar losing real purchasing power against a basket of whatever somebody's buying. The other is the relative measure against other fiat currencies, which tends to be more about the race to the bottom, so to speak, in a competitive devaluation scenario. Is it both of those things? Is it one of those things predominantly? What is it that you really see going on here in terms of the outcome that you're predicting? Is it a loss of purchasing power, or is it a relative decline relative to other fiat currencies because of the dollar's changing role in the global financial system?
I think it's both. I think relative to other currencies, if you look at what China, Russia, or excuse me, the creditors of the system as they stand now, which are really the big three. It's China, it's Japan, and it's Europe. And if all three of them, and in particular China and Europe, the two biggest, can buy energy, in particular commodities more broadly, in their own currency, increasingly on the margin, then that system is one where basically every major player has to finance their own deficits, as opposed to a system where all commodities are bought in dollars and everybody finances the U.S.'s deficits for the U.S. And so if everybody has to finance their own deficits, it comes back to a relative game of who has the biggest current account deficits to finance. And the Europeans have the biggest current account surplus in aggregate. That's primarily Germany, but EU has the biggest current account surplus. China has the second biggest current account surplus. The Japanese are third. There's a bunch of countries that are slight surpluses, slight deficits. And then there's the UK, which has a really big deficit. And then the United States, which has an enormous current account deficit. And so effectively, what has to happen if these creditor countries can buy their biggest deficit items, which are energy and commodities, generally speaking, in their own currency, is everybody's got to finance their own deficit. And Europe and China and Japan don't have deficits. The UK and the US do. And so they're going to have to print the money. Basically, they have to find someone to finance those deficits. And if our view has long been that the way those will be financed is by the central bank with printed money. And that's what's been happening. And so basically, you would reorder the global currency system along the lines of in order of current account balance, which is the way the currency system worked for pretty much all of history up until 1971. And so I think you'll see the dollar weaken structurally against the euro, against the yuan, against the yen over time. I think the sterling or the pound sterling will weaken against the euro, the yuan, and the yen over time as well. The question then just tactically is always the U.S. has to print the most, but will they print the fastest? And in 2020, they printed the fastest as well as the most. And the question is going forward, will that be the case? And there are signs that as of right now, the U.S. won't, the Fed won't print enough or fast enough relative to what they need to, which would be good for the dollar, because we saw in 2018 the U.S. didn't print enough. It was good for the dollar. They didn't print enough in 2019, at least until the very end of the year. It was good for the dollar. And so it's really both against CPI and against foreign currencies as well.
Let's talk about the political situation in the United States and the Democrats having just taken control of the Senate. A lot of people are connecting this with the increase in bond yields. And the argument is basically if you've got an expectation of a whole lot more deficit spending, that means the government's going to have to sell a whole lot more bonds. If you're selling more bonds, that means there's more supply, less demand, the price goes down. It seems to me that kind of misses the question of, okay, but what's the Fed going to do to intervene and not allow yields to go too far in the other direction? How do you see this playing out in terms of what the Democrats taking control of the government, the expectation of more spending? How does that play into this whole picture?
So I think it's interesting to see that U.S. tax receipts have begun declining again on a year-over-year basis when you look at it on a trailing 12-month tax receipts. And it coincides with the roll-off of stimulus. And so if the U.S. economy can bounce back strongly, then that's one set of outcomes. But as it looks now, it looks like the U.S. economy can't survive really without increasing government stimulus. And I think, at least in the near term, until we fully recover from COVID, that's probably the case. And so then you get to the point of, that you just made, which I think is the right one, that by all accounts, it sounds like the Democratic control of the White House and Congress is going to result in increased stimulus spending. And all else equal, if I was a bondholder, that would make me want to sell bonds, make me want to sell treasuries and yields up. And to your point, the $64,000 question is what is the level of yields that A, freaks out the Fed and or breaks something systemic in markets? And I think really realistically, that's probably one and the same thing. The level that freaks out the Fed is the level that causes something systemic to break. And so I think basically we're likely to continue to see yields rise in the U.S. until something systemic breaks. And what's interesting is it's been linear to this point. I think we're now getting to yield levels where at some point in the not too distant future, those linear increases in yields will start to become nonlinear. It'll be more of a sort of a gamma trade where it just feeds on itself for hedging, et cetera, as people hedge further risk of yield increases, et cetera. And I think we could go from sort of a linear orderly rise in yields to a disorderly rise in yields. And at that point, I would expect the stock market or portions of the stock market or something somewhere else to break. And at that point, I would expect the Fed to do exactly what you noted, which is come in with yield curve control of some description or increase the monthly levels of QE to get that under control. What's been interesting to me in this whole process has been that the dollar hasn't responded to these yield increases at all. And I think Louis Gabb said it best a couple of weeks ago in an interview. He said, when I see a nation who has rising yields and a falling currency, alarm bells go off. That's a symptom of a balance of payments problem. And I think that's away from the yield increases, which I think the Occam's razor explanation for why yields are rising, particularly post-election, is on expectation of the stimulus. I think sort of the reason behind the reason is that the reason we need the stimulus is because the U.S. has a balance of payments problem in the aftermath of COVID. When you look at the hole that was blown in the U.S. fiscal budget after COVID, it really looks, to our eyes, irrecoverable without some massive stimulus or a big devaluation in the dollar or something of that sort.
Now, a phrase that I've heard you use a lot before, Luke, is deficits don't matter until they do. The implication being that at some point, if you no longer have the position of prominence that the U.S. has enjoyed with the rest of the world buying up its debt, all of a sudden the game is different. But, on the other hand, you can spend pretty much an unlimited amount of money if the Fed just buys all the treasuries, and you don't have to depend on outside investors for that. How do you see this increased spending, lots and lots of stimulus planned, a growing political sentiment around MMT to sort of say, let's just spend whatever we need to. We can always print the money to buy the bonds if necessary. How long does that game go on until deficits do matter?
I think they've started to matter already. I think they started to matter in 3Q14 when global central banks stopped buying treasuries on net. If you look at what they have bought from 3Q14 to present on net, they have not added any treasury bonds on net to their FX reserves, which I think that is really the kickoff of when they started to matter. And there have been, on this front, a couple of interesting op-eds in the Wall Street Journal in the last month. One by former Goldman CEO and Treasury Secretary Hank Paulson, one by former Fed Governor Kevin Warsh last week. And both of them, I think, are really important op-eds because they both suggest that the Fed and the U.S. government have a problem, which is that the U.S. needs to refinance, call it $7 to $8 trillion net this year. In 2020, the Fed bought more than 100% of net issuance of U.S. Treasury. And so the Fed financed more than 100% financed the U.S. government effectively last year. And we saw that in the response of the dollar. But for 2021, at this point, the plan, and this is as far as I know, before any additional Biden stimulus, the plan is that the Fed is going to buy, or the net issuance is going to be $1.8 trillion more than what the Fed is going to buy. And so the issue is that now you're back into this dollar short squeeze mechanic. And so the U.S. government will be in a position to crowd out other global private dollar markets, send the dollar higher, send yields higher. And so that's sort of one side of the coin. The other side of the coin that both Paulson and Warsh talked about, Paulson's article, I think op-ed was titled "Beijing Wants to Be the World's Banker," and Warsh's talked about the same thing, which is that China is putting pressure on the U.S. They're keeping us honest. And for the last 30 years since the Berlin Wall came down, we haven't had anybody else to keep us honest, which is to say, both Paulson and Warsh noted that you can get 3.25% in a Chinese 10-year versus whatever we're getting. And so you're seeing capital flows to China away from the U.S. At the same time, China has recently signed this massive trade deal, the RCEP across Southeast Asia, and the European investment deal. And so you have two stalwart U.S. allies in the EU and Japan signing on with these big trade deals with China in the last month. And so there's this capital flow issue that Warsh and Paulson identified. You've got the Fed needing to help the U.S. government finance these deficits, but the dollar sitting right at a crucial level where if the Fed does do more, you run the risk of what I would say is truly the Fed's worst case scenario, which is the dollar starts falling and the equity markets start falling in response to a falling dollar as opposed to rising like they did again last year, in which case the Fed is really hamstrung. And so I think the Fed is sort of caught between a rock and a hard place where you're seeing capital flows away from the U.S. You see it in the performance of the Chinese stock market. You see it in the performance of the EU stock market. You can see the relative interest rates higher in China. Domestically, you're seeing capital flight into Bitcoin and gold. The gold volumes have been physical gold volumes. I think I saw one the other day up 700% year over year. You've got this financing problem where you need to finance it. If rates rise too much, you cause stocks to fall. But if you help too much financing it, then the dollar falls and you could have stocks fall because the dollar's falling too fast. So I think the Fed's really pretty cornered. And I think it all points to this. When do deficits matter? I think they started to matter, 6.5 years ago. And I think we're getting to the point of the game where we wrote a report the other day is sooner or later, everybody sits down to a banquet of consequences. It's a quote by Robert Louis Stevenson. And I think 2021, we're all going to sit down to this banquet of consequences. The Fed's going to have to make a choice of what they want to do.
And what's the trade-off in that choice that will confront us in 2021?
Crush the economy or crush the dollar?
Luke, expound on that. How do we crush the economy? How do we crush the dollar? What are the mechanics of each of those options?
So the crush the economy is effectively let the Fed stands aside, does whatever they're going to do in terms of QE or even taper QE, and force the global private sector dollar markets to finance U.S. deficits and let interest rates just rise and rise and rise and go to wherever they're going to go find their level until something really breaks. And crush the dollar is effectively have at that point, either at that point or prior to that point, have the Fed say whatever the Biden administration wants, we'll supply. Or, yield curve control. It's just another way of saying yield curve control, really. It's just saying we're not going to let yields go over X, and whatever the Biden administration wants to do, they can do. Yields are not going to go over X. And what yield curve control will do will effectively create the Lacey Hunt scenario of the Fed will be lending to the government who will be spending. And yeah, they'll be separate entities, but they'll be married. And if the husband's lending and the wife is spending, the household is spending. and it'll be the same type of thing. So those are really, I think, the two paths that the Fed's going to have to choose here in 2021, the banquet of consequences.
Do you have a view on what their choice is likely to be?
I think they would love to keep riding two horses with one ass for as long as they can. And I think they've done a very nice job of it. I think these Paulson and Warsh op-eds are a sign to try to defend the dollar and the dollar system for a little bit longer. You've seen the Fed over the last couple different Fed officials over the last several days talk about, well, maybe we can start to think about tapering here or there. And so there's some jawboning going on to that effect. Ultimately, I don't think they have a choice. The only politically palatable choice is to supply whatever the Biden administration wants. And part of that is because of what we saw in 2019 and 2020 with the repo rate spike and then how the Treasury market traded. Because the thing that very few people are talking about is because of how dependent on the stock market the U.S. economy has become, once the stock market falls enough, it starts to reflexively reverberate back into the Treasury market. And so we saw back for 9 days in March of 2020, we saw from March 9th to March 18th, 2020, we saw the Treasury market begin to crash alongside the U.S. equity market nearly tick for tick. And that was not an accident. That was something that I thought would eventually happen. I was surprised how fast it happened. Some of that has to do with how severe the sell-off was related to COVID. But the issue is with the U.S. government's debt as high as it is, with foreign central banks not buying treasuries the way they used to, with the U.S.'s net international investment position at negative 60% of GDP, which means foreigners own $40 trillion gross, $12 trillion net of dollar assets, with the foreigners being as short dollars as they are relative to their dollar borrowings, and of course, relative to Jeff Snyder's ongoing point about the Eurodollar market. The point is basically as soon as the dollar gets too high, they begin dumping dollar assets, and they dump what they can, not necessarily what they want to, and what they can dump are treasuries. And so paradoxically, something that we've begun to see, and which I think we will see in spades in sort of each cycle going forward for the foreseeable future, is that once the stock market falls too far, Treasury yields will start rising, which is the complete opposite of everything we've seen throughout our entire careers. I've been doing this 25 years, and up until March of 2020, when stocks fell, yields went down. And March 2020, stocks fell and yields went up. And that's a classic emerging market thing, the balance of payments problem, yields. And we saw it again in October. Dow was down 800 points one day in October, I forget which day, and the TLT was down, yields were up. So long-winded way of saying is the Fed has a choice, but it's really a Hobson's choice, which is to say they don't have a choice, because they can pretend to try to defend the dollar. They can try to defend the dollar. I think they might even be about to here for a little bit. But the second the dollar gets too strong, you're going to start to see stocks sell off. You'll see the economy start to weaken as a result of declining stock market, consumption through the consumption link. And you can't have GDP decline when you're running debt to GDP at 130%. Because you'll default on your debt. So it really is just a question of path. My bet is that they probably try to defend the dollar here for a little bit, but that ultimately they're going to have to acquiesce and basically use yield curve control sometime later this year to provide the Biden administration with what they want.
Well, I have to confess, Luke, it was a trick question because I knew the answer would be it's really hard to tell, and we're not sure exactly when each decision is going to be made. With all of that in mind, how do you translate this back to an investment strategy when clearly there's a lot of moving parts here and it's not clear exactly which direction is going to happen when?
It's hard. It's very political. It comes down to not just the domestic politics, which I think people are very focused on, but these international geopolitics that I think people are at this point still relatively less focused on than they are, at least here in the U.S., of the domestic politics. Look, for me, because I'm of the view that any whoosh or any down move down is likely to be a whoosh move down, I continue to be positioned as I've been positioned all through last year, which is I own gold, I own Bitcoin, I own gold miners, my three largest positions, and then I also own a lot of equities, and I own no bonds. And that's how I've been positioned over the last, really in December, actually, when Bitcoin broke above 20,000, I added quite a bit to that position, actually. And so I am completely cognizant that the risk is that they try to strengthen the dollar or support the dollar. And if they do that, that's not going to be good for any of my positions. I'm unlevered, and so I'm willing to take that pain. If I was running a book where I was managing money on a monthly basis, I would probably be de-risking a bit right here relative to those positions to give myself a little bit of cash and some dry powder and some cushion. Basically, that I think they may try, like I said, to defend the dollar system as advocated by Warsh and by Paulson in the last month. But the holes in the system are just so big, and the holes in the fiscal position are just so big after COVID. And when I say that, I should probably define what I mean. What I mean by that is if you look at the third quarter TBAC, Treasury Borrowing Advisory Committee report, it shows that the U.S.'s big three expenditures, entitlements, defense, and interest expense / Treasury spending, are 140% of tax receipts. If you look at that same report, it shows you that U.S.'s true interest expense, which is interest expense plus the entitlements and the pay-as-you-go portion of entitlements, it's 120% of tax receipts. So what that tells you is that if the U.S. tries the austerity route, they try to strengthen the dollar, they try to squeeze out adversaries, it's not going to be very long before the U.S. doesn't have the money to pay entitlements, defense, or interest. And the U.S. is not going to default on any three of those for lack of money, for lack of printed money. They will get that money. And so that's my point there in terms of that. What it all points to, with the debt being where it is the U.S. needs significantly negative real rates for an extended period of time, and increasingly negative real rates. And so consensus to me still appears to be that U.S. real rates bottomed in August at negative 1.1%. I think they're probably, I think at a minimum on their way to -5 and maybe on a way to -10 or more.
Now, that is just fantastically bullish for gold in the long run. But what we're hearing this week, and I certainly agree with it, is some analysis saying, look, the reason that gold is off this week and likely still has room to go to the downside is specifically because rates are backing up right now. And at least short term, the trend is higher real yields. How long do higher real yields last? And I think that's explained, as we talked about at the beginning of this interview, by the expectation of a lot of stimulus spending resulting in the Treasury having to sell a whole bunch of bonds to finance that government spending. For the moment, the trend is higher real yields, gold down. Do you wait this out for that to get to some better buying opportunity, or are we already there? How do you play this with respect to gold and where you think real yields are going to go?
It's a great question. I think it just depends on your time horizon. But I think ultimately the U.S. is so levered to the stock market. The U.S. is so levered, period. We're talking about basically if real rates keep rising, do you want to buy gold here with, 5 to 7% downside, 5 to 8% downside, and a whole bunch of upside? Or would you prefer to wait and maybe pick it up 5 to 8, maybe 10% cheaper? I'd be shocked if it got 10% cheaper, but certainly, I suppose, possible, and buy it there. To me, it feels cute because the flip side to that is, when you're talking about a trade that has 5 to 8, let's say 10% downside max and 50 to 100% upside, because the flip side of it is if Biden comes out and says we're going to do $2,000 to everybody, and by the way, I'm also going to do an executive order where we're going to forgive $50,000 of student debt for everybody. You're never going to get gold better than here again, probably for the foreseeable future. So to me, I don't trade month to month. I would rather I'm a buyer of it here. I'm a buyer of Bitcoin here. I'm a buyer of gold miners here. If you're a trader with real rates doing what they're doing, I get it. But to me, it just feels trying to be cute.
I want to touch on the Bitcoin versus gold subject because I know that you have for a long time been investing in both Bitcoin and gold. It seems to me that you could argue this two ways. You could say, look, gold is really in a soft patch here, and, well, at least until last week, Bitcoin was having an incredible bull run. It was time last week, maybe not as much this week, to take profits and rebalance. If you see you've got two assets that have the same goal and one tremendously outperforms the other, the rebalancing theory is you lighten up on whatever has done better, because you figure that it's a good time to shift to that allocation so that you're selling the high asset and buying the low asset. The other argument that I guess you could make is, now look, this is happening because gold is old-fashioned. It's your father's Oldsmobile. Bitcoin's the new thing. You don't want to be taking away from your Bitcoin position to be buying gold. If anything, you should go in the other direction because gold's on the way out. Which way do you see this, or is it something completely different?
I see it as I think there are a number of things that Bitcoin does better than gold. And there's a number of Bitcoin proponents that would tell you what those things are. I think there are two things where Bitcoin underperforms gold, or it does worse than gold. And those two things are, number one, gold is final payment. It does not have any additional energy debt owed to it. In other words, you hold a gold coin in your hand. You don't need electricity to make that gold coin work, to make it stay. It is final. It's a reserve asset with no additional energy debt owed to it. Whereas Bitcoin has an ongoing energy debt owed to it in the form of the grid and the amount of energy it will take to keep all the miners and all of the network and nodes all going. So that's one way. The other way that I think gold is better, or at least needs to be in a portfolios alongside Bitcoin, is that gold sits on central bank balance sheets. Gold sits on the U.S. government and other sovereigns' balance sheets, and Bitcoin doesn't. And I think this is relevant, particularly now when you get to a point where the center of the system, the United States, is as cornered as it is fiscally and from a debt perspective. And what I mean by that is We wrote to our clients recently, if you look at the Warsh interview or the Warsh op-ed in the Wall Street Journal, it's fascinating because it lays out that, okay, we need to refinance all this debt. We need the Fed to do more. But if the Fed doesn't do more, then rates will rise and risk assets will eventually fall. If the Fed does do more, then the dollar will fall, and it's getting to a level where it could get disorderly fast. And then we could see asset prices fall because the dollar's falling so fast. And we need to raise rates to defend or to compete with China because they're offering 3.25% and we're offering 1.15%. And they've got this trade deal that now they've signed up with people. So there's actually going to be more demand for their bonds as it is. And we've got this Bitcoin thing going on in the US where there's very clearly starting to be a bit of a jailbreak with US investors, US retail investors, US corporations saving in Bitcoin instead of in treasuries. So we need to do the Paul Volcker playbook and raise rates to defend the dollar. But if we do that, we'll break the system and rates will rise anyway, which is, we're sort of in trouble because unlike when Volcker ran his playbook, US debt to GDP was 30%. It's 130% today. So the thing that's very, very different now versus 1980 is if the US runs the Volcker playbook, the entity that will go broke relatively quickly will be the US government without Fed printed money, which defeats the whole purpose. And so what I think is the other big advantage or the other reason I think you need to have gold alongside Bitcoin is the way out, if you read the Warsh op-ed, is for the U.S. needs to delever its own balance sheet in order to normalize rates without bankrupting the U.S. government to be able to defend the dollar. So what do? There's a playbook where the U.S. Treasury could instruct the Fed, I want you to remonetize gold at some really big number. And basically every $4,000 on gold is about $1 trillion that would be deposited into the U.S. Treasury general account, because that's how it works. So basically, if Treasury tells the Fed to remonetize gold, the funds show up in the TGA, the Treasury general account. And the Treasury could then spend that into the economy however they want to spend it. And so let's say the U.S. government, the Treasury says, I want to put $5 trillion into the TGA. 5 trillion divided by 1 per 4,000. So that's 5 times 4,000. It's $20,000 more on gold, but gives me $5 trillion into the TGA. So now the TGA is sitting at 5 trillion plus. And the Fed's data in terms of the stimulus around the COVID stimulus was that it was about a multiplier of 1.5. So we take the 5 trillion, we spend that on a variety of stimulus infrastructure in the US with a multiplier of 1.5. So it's $7.5 trillion. 5 trillion times 1.5, $7.5 trillion. $7.5 trillion on a $22 trillion GDP is going to significantly delever the US's economy. By the time that's said and done, you're going to be talking about debt to GDP that's gone from 130% to probably something well below 100%, at which point the Fed then could raise rates, normalize rates, and away you go. And so the punchline is that basically, because the Fed is so cornered, because the Treasury is so cornered by the factors I described, it's increasingly looking like the only way out is to use the gold to delever the Fed's balance sheet and then raise rates. And so I think that's why you need to have both gold and Bitcoin on your balance sheet. And in terms of balancing, I think it's a personal preference. Obviously, you can see the relative volatilities are very, very different. But for me, I like having them both in pretty good size alongside each other.
Let's tie this back into the stock market. I can make the argument that, hey, look, it's 10 years of straight up for the stock market. It's way overdone. We're at the final blow-off stage of a very, very late stage bull market, which surely must be about to end. Or I can make the opposite argument that based on the amount of stimulus and the political will to create more and more money, balance sheet expansion and so forth, could be just the beginning of a crack-up boom that takes the stock market, at least in nominal terms, straight up from here. Which side of that argument would you pick, or is it even possible to know?
I shade towards the crack-up boom. And the reason that is for a number of years now, I think investing has become increasingly a relative game. I guess it's always a relative game. But what I mean by that is, yes, stocks are expensive. Yes, real estate's expensive. Yes, there's a bubble in everything. But the biggest bubble of all by far is in sovereign debt and specifically in U.S. Treasury bonds. And U.S. Treasury bonds are the risk-free asset underpinning everything. And what I mean by that is yes, the NASDAQ is expensive at whatever it is. It's how many times earnings, how many times sales, home prices at however many times income. But if you take a look at U.S. Treasury bonds, you have the U.S. government is an entity that has, we're not going to look at, we always quote debt to GDP at whatever, 130%, 70-year high. Well, I think it's relevant if you want to look at the comparative bubbles, look at the U.S.'s debt to revenues. U.S.'s revenues are about $3.3 trillion. We've got $27 trillion in debt. And so right now, the U.S. government, U.S. Treasury bond sells at 9 times revenues. So then you say, okay, the U.S. government, the U.S. Treasury had the valuation of their OPEB liabilities or pension and entitlement liabilities. U.S. owes somewhere between 100 and 200 trillion there off balance sheet. So the Treasury is, again, 100 to 200 trillion divided by 3.3 trillion in revenues. Treasuries are trading at somewhere between 33 and 60 times revenues. Furthermore, since the U.S. has not run a surplus since 2000, we have not turned a profit in quote unquote profit in over 20 years. And so when you look, and what's more is our biggest creditor, our biggest bankers cut us off in 2014 and 3Q14 when foreign central banks stopped growing their holdings of treasuries. And so when I look at the valuation of everything, I have to start with the asset that underpins all of it, the risk-free asset and the capital asset pricing model is arguably the biggest bubble in the history of mankind. And if I start there and say, okay, well, if the quote-unquote safe asset is in sort of ludicrous range of valuation, then it comes down to, I want to own stuff that's more finite. And so would I rather own a U.S. Treasury bond or would I rather own a share of Microsoft? Would I rather own a share of Amazon? Would I rather own a share of Intel? Would I rather own a share of Parker Hannifin, Eaton Corporation, Boeing? And to me, the answer has long been and continues to be, I'd rather own the latter because there's just, unless there is a significant political change shading towards austerity, I just don't see how this doesn't continue and make, I think it forces sort of this crack up boom dynamic within all other asset markets.
Well, I agree with you on the crack up boom being the more likely outcome. And it seems like really the environment we're in is if the only way out of this for the government is to depreciate the value of the currency, that means the price of everything has to keep going up. But that begs a question, Luke, which is so far, curiously, despite many predictions of runaway inflation dating, back 10 years now, what's really happened is there's been this explosive appreciation of financial assets, but really in terms of consumer price inflation, it's been a lot more muted than what some people expected. Are we finally at the point where we're getting close to, a transmission of this into the real economy and runaway wage and price inflation?
I think we're getting closer. Yeah, I think we're almost in between two trapezes. If you look historically, and Professor Richard Werner's done a lot of really good work on this, there's two components of inflation, basically. There's the asset price inflation, and then there's sort of real economy inflation. And we have structured our economy to basically sterilize what the central banks have, with the government spending through asset markets, a number of different ways. And so that's where the inflation has shown up. Now, I think the reason that's changing is just twofold. Number one, Lynn Alden has a great chart showing QE and the fiscal deficits in 2008, 2009, 2010, and last year. And it's a night and day. In 08, 09, 010, the deficits did not blow out. So basically, the government did not spend to stimulate. And this time they did. And so we did start to see some CPI inflation metrics rise off of low levels in the back half of last year in particular, but I would argue that was still just filling in a hole. What is starting to be harder, or why I think it may have more legs than most people think, is because of the damage of COVID, because the U.S. government, the debt is as high as it is, because aggregate debt is as high as it is, it means no one can afford a recession without touching off a death spiral sort of across the system. And because the U.S. government is now such a big part of GDP at 20 or 22% of GDP, they can't pull back. And so people say, well, you need the banks to lend to drive inflation. And I think that's true. Then you take a look and see at what happened in 2020, which was that U.S. bank loans to the U.S. government were up about 35% year over year, which is to say their holdings of treasury bonds rose 35%. And so you're seeing banks lend very aggressively to the government. Ostensibly, some people, I know Jeff Snyder says that's just because they want to be safe. Maybe that's true. But at the end of the day, functionally, there's no difference between a bond and a loan. And so the banks are lending to the government, and the government is absolutely spending. And so it really is a political question then of are we about to get that inflation? And to me, the politics all point in one direction, which is yes. Whether you look at what happened last week, whether you look at the unrest over the summer, et cetera, to me, it seems pretty clear that the political winds are suggesting that the government increasing their spending of Fed and federal bank lending, U.S. commercial bank lending, will continue and accelerate. And if that happens, then I think we will see that inflation show up.
And do you have a time frame? Generally speaking, when inflation starts, it's good news in the beginning until you start to get to the wage and price part that tends to be more of a draw on the economy. And usually the beginning of an inflation, it's good for the stock market, and it becomes bad for the stock market only when the real economy starts to suffer. How far away are we from the point where it becomes a significant stock market headwind as opposed to the tailwind that it always starts as?
I think we're a long way from it. And the reason I say that, there was a great tweet by Mike Krieger last week or maybe the week before, and it was, let me make one thing clear. There is no Paul Volcker coming this time. And it was a great, great tweet. And the reason I think it's such a great tweet is you can see how this is going to go. The U.S. debt to GDP is at 130%. When Volcker showed up to control inflation, it was 30%. And our demographics are much older, and our economy is significantly more financialized, which is to say every 100 basis points higher is a much more pronounced negative impact on the U.S. economy than it was back in 1980. And so the way I think this goes down is I think my base case is the Biden administration comes in, they spend more, the banks, U.S. commercial banks and Fed increase their holdings of treasuries. The government then spends more, and that goes on. Eventually, we start to see it show up in CPI. The bond market backs up to a point, and the bond market's going to back up to a point when CPI does something. And unlike when Volcker showed up, he stomped out inflation. What the Fed's going to say is, okay, that's it. The 10-year's not moving any higher than 2%, no matter what we do. And then the Biden administration comes out and says, hey, it's $3,000 checks this quarter, guys. And the Fed buys more 10 years. 10-year doesn't move over 2. Wages start rising, CPI higher, 2%. And so basically, at some point, not too far along that whole process, the Fed's balance sheet goes 7 trillion, 8 trillion, 10 trillion, 15 trillion, 30 trillion. As the entire bond market starts to realize, oh my God, they're not going to stop this. They're going to delever on the back of my purchasing power. And so it's a very slippery slope. It's one I think that has the Fed scared to death. I think it's one that's inevitable the Fed's going to have to do. And what it speaks to is that I think the reason they're so coy about yield curve control is that I think they know that after Treasury yield curve control, like 2 months later comes corporate curve control. And then after that, mortgage curve control. And then after that, junk bond curve control. And it's a very slippery slope where by Christmas 2022 or July 4th, 2023, the Fed could own some gigantic percentage of the entire dollar bond market globally. And that's, I think, why they don't want to start yield curve control if they can avoid it. But I think that's where this movie's going. Now, once inflation runs high enough for long enough, and if you run wage inflation at 10 or 15% for 5 years and everyone's mortgage is pinned at 3%, that's a debt jubilee. And everyone, in 5 years wakes up and their mortgage is, instead of being 40% of their monthly income, it's 5% of their monthly income. And at that point, you can raise rates and you can normalize the curve, and sort of in theory, you probably have to take some draconian steps at some point to sort of bring inflation back under control. But I think that's where this is all going. And, to me, the biggest question is just are we going to start that process right away under the Biden administration, or are we going to run through the charade of, we're going to try to defend the dollar system one last time and blow up risk markets and then give the Fed the cover to come in and start this process after sort of a whoosh down? That to me is really the biggest question in my mind.
You mentioned a debt jubilee, and that got me curious because back when Paul Volcker was still alive, he was very outspoken publicly in saying his own prescriptions that fixed inflation in the early 1980s would never work today because of exactly the reason that you stated, that we have a dramatically higher federal government debt level. So does that mean that when we someday, and I do not think it's coming tomorrow or anything like that, I think it's still quite a ways off, someday we're going to get to runaway inflation, where inflation is running out of control and something has to be done to contain it? Volcker's prescriptions clearly will not work per Volcker's own admission before he died. Does that mean a debt jubilee is the only choice that's left, or are there other options?
No, there's another option. That's option one. Option two is what we talked about before, which is Treasury says, Fed, we want you to bid for gold at $50,000 an ounce. And, let's use 40 for round math. At $40,000 per ounce, the math we laid out before, that's $1 trillion into the TGA for every $4,000 in gold. So there's $10 trillion into the TGA. $10 trillion into the TGA at a multiplier of 1.5 that we talked about before with the Fed's own math would give you an impact of $15 trillion spent into the economy. And if you did that, the U.S. economy would basically, that money in the TGA would represent an increase in U.S. government spending without a commensurate rise in U.S. government debt. And it's a way to delever. It's a debt jubilee. You do it all at once. It would result in a massive one-time surge in inflation. But you'd wake up and U.S. GDP would be, $35-40 trillion in 2 years, and debt would still be sitting at 27. And so we would be at 60% debt to GDP, call it, for easy math. And at 60% debt to GDP in a couple years, and really you could probably start all along, but at that rate, you could take Fed funds from 0 to probably 3. And you could take the 10-year from probably wherever it is today, 1.15, 1.2 to 5. And the banks are healthy, and because they're making a positive spread. The inflation in the economy nominally is preventing anyone from defaulting, which otherwise would occur if you tried to raise rates in that fashion without first doing something this draconian. But that's the other way you can do it. So it's really, their choice is, in my view, the only politically palatable choices are to sort of do it in a process over 5 years, or do it all at once in this sort of remonetizing or using the gold to basically do a one-time massive increase in the TGA, using the gold to basically fund a massive infrastructure and stimulus spend instead of funding an infrastructure and stimulus spend with further increases in debt, which is just chasing your own tail. And this is something mainstream economists are absolutely aware of. If you go back to 2013, Paul Krugman wrote about the $1 trillion platinum coin, if you remember that. He wasn't the only one, where he said, look, we could mint a platinum coin and say it's worth $1 trillion, and then we could spend that money into the economy and get our way out of this. And so it's gimmicky, it's wonkish. It would absolutely work. The question just really is one of how they want to go about it and what sort of political processes would they need before they did it.
Let's talk about something that a lot of people think could be very, very near term on the horizon in the Biden administration, which is a forgiveness of student loan debt. That would be, in a sense, debt jubilee light. Is that coming? And if so, what are the consequences and knock-on effects in terms of financial markets?
I don't know if it's coming. I have been following it with great interest. I saw something that Biden allegedly said that he thought the legal basis for him to do that was arguable. In other words, he wasn't sure he had that authority. I've seen others say he could do it via executive order on day one. So I just don't know. In terms of if he did it, I think it would be enormously bullish for stock markets broadly, I think it would be quite bearish for the dollar. I think it would probably be bearish for bonds. I think it'd be bullish for gold. I think it'd be bullish for Bitcoin. It would, on one level, be opening a Pandora's box, but on another level, it's probably the right thing to do relative to where we are politically, divisively. Basically, having a bunch of young, highly indebted, angry people is suboptimal, as we're seeing. And I don't know how much longer we need to see this for before we start doing something like this, because this is going to be the end game no matter what. We can sort of choose the happy way of doing it, or we can do it the hard way. But that's how I think from a financial market perspective, it'd be stocks up, bonds down, dollar down, gold up, Bitcoin up.
Luke, I can't thank you enough for a terrific interview. Before I let you go, tell us a little bit about what you do at Forest for the Trees.
Absolutely. So we do unique investment research. We aggregate a large amount of information from publicly available sources and put it together in a unique manner, trying to identify developing economic bottlenecks for our clients. And we publish reports weekly for our clients. We've got an institutional product. We have a retail and small investor product, both of which are quite popular. And if you want to learn more about either one of them, you can check us out at our website, fftt-llc.com, or you can look us up on Twitter at Luke Gromen, LukeGromen.
And again, that's fftt-llc.com. Patrick Ceresna and I will be back as MacroVoices continues right after this message from our sponsor. After being completely sold out of advertising capacity for months and months, we finally have some MacroVoices ad inventory opening up. There's still just one episode per month available for the remainder of Q1, and then in Q2 we have more ad capacity opening up. We prefer to find a single advertiser who wants to advertise in all 13 episodes in Q2, but if we don't book one, we'll probably continue offering 1 week per month packages for advertisers who only want to advertise in 3 or 4 episodes during Q2. For rates and details, please email us at sponsorship@macrovoices.com. Now let's get back to the show.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was so great to have Luke back on the show. Really enjoyed his interview.
I really enjoyed talking to Luke, too. And, of course, listeners, don't worry. We understand Luke is one side of the equation. We're working on getting other guests to tell the opposite side of the story, because certainly there are different views on where the dollar is headed and what might be next. Meanwhile, I'm certain of what's next on this episode of MacroVoices, which is Looking Under the Hood of Markets, the title of this week's Postgame chart book. You'll find the download link in your Research Roundup email. If you're not a registered user yet and don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads above Luke Gromen's picture. Patrick, let's look under the hood of this market. Page 2, S&P 500 futures. Boy, sure looks like the relentless climb is continuing.
The climb is definitely continuing, and some of these different measured moves that we do are targeting levels toward 3,900 and 4,000. So, I mean, the market edging higher is definitely on the table. The interesting part is that we're going into a major option expiration. Usually, we've had Charlie McElligott on the show before talking about the gamma pins and some of the variables that come in. So it's entirely possible we're going to be closing somewhere around this 3,800 level going into there, but it'll be really interesting to see whether or not the volatility returns next week. And what we find is a very interesting circumstance where even though the rally has been very methodical and just slow in its grind, I want to talk about some other charts that just tell a little bit of a different storyline. But what is interesting on this particular page is how bullish the sentiment has gotten. We're now seeing a situation using everything from the breadth of the market to momentum and put-call ratios. We've now reached a point of sentiment to the 98th percentile going back to 2004. This is from Nomura Research. And really, we just have a market that is incredibly bullish from sentiment perspective. A lot of people ask me, well, why does the top have to even be considered here? Because the market hasn't really started to melt up yet. We haven't seen this S&P really accelerate to the upside. So why is there risks in the market? So I wanted to put a little bit of context on that. And on page 3, what I wanted to do is look at the performance of different parts of the market in this kind of post-market crash period. So everything starting in that March-April period. And the black line at the very bottom is the S&P 500 performance. And what you can really see is that the majority of the performance has come in a lot of the secondary kind of areas. Like, for instance, semiconductors are up at this stage, 117% off of their lows. But then you take something like the copper producers up almost 200%. Then I decided to put ARK Investments, Kathy Wood's ETF out there, up 260%, and of course the TAN index, which is the solar ETF, up almost 400% off of those lows. So there's all sorts of these sectors that are doing these much accelerated parabolic rises in a span of less than a year. And what it reminds me a lot of, and I wanted to kind of go through the thought exercise of on page 4, looking at what happened back in the 1998 to 2000 period. And what we have here in the black and yellow line is the Russell and the S&P 500 performance, which were doing pretty good and all right on their rise, and in fact were not impressively strong in the final 6 months of the rally, but it was the NASDAQ that went parabolic up 300% in that big bubble blow-off. And so even though we're seeing all these bubble kind of price action in some of these different markets, but it doesn't have to necessarily mean that the S&P has to rally in order for some sort of a market top and mean reversion to begin on many of these moves.
Yeah, this chart really speaks to me in terms of how much farther the craziness in Bitcoin could continue. And I do think it's a speculative mania. I don't think there's any fundamental justification for this big rally that we've seen in Bitcoin. But if you look at what happened in the late 90s, you had what were frankly some pretty darn simple concepts that for some reason Wall Street guys just couldn't get straight. The web is going to be a big deal, and that means that websites that actually make money are going to be really, really valuable. Somehow that got translated to anything that has .com in its name is selling at, a zillion times earnings, or it doesn't have to have earnings, or it has no plan to ever have earnings, or what have you. And it was just crazy. And eventually they sorted it out and they figured out that, yeah, the web is going to be a big deal, but that doesn't mean that people who have no business plan and are just putting, companies together based on nothing should be rewarded. And it took a long time for them to figure that out. And the thing is, it was pretty simple. Now, if you take what's going on with digital currency, which is going to completely change the world, and you really try to get your head around it and understand why there is a big difference between saying that digital currency is the way of the future, which I'm convinced that it is, versus saying Bitcoin is going to be the predominant digital currency, which is what the so-called Bitcoin maximalists think. That's a much bigger piece of technology to get your head around and understand than what we were wrestling with in the late 90s by at least a full order of magnitude. And, if it took us a few years in the late 90s to figure out that these valuations were nutso before it finally, had a blow off top, it says to me that the crypto craze probably could run for quite a while longer. Most people don't understand it at all. And I think there's lots of room there. In any event, I know crypto is not where you were headed with this, but I'm curious to get your perspective on that, Patrick.
Well, I just wanted to add to that because I think that while crypto is certainly got all the characteristics of that bubble parabolic rise, there's no shortage of sectors within the markets, and especially in the EV space and the solar stocks, and there's a whole series of different sectors within the market that are seeing the same parabolic moves. It's just the typical froth that's associated in the easy money environment that comes in these kind of bubble phases. And one of the things, though, that I wanted to kind of think through and really debate, on page 5, what I was showing was the bear market that followed. And what I really want to capture, not this as an analog of what I believe believe is imminently going to happen to the stock markets, but rather the sector that performed the best on the way up was the one that underperformed the worst on the way down, or had the most room to fall. And while because of all the inflation expectations, there's a lot of people arguing that this time around we're not going to have a bear market the way we did, let's say, back in 2000 to 2002, because stocks are an inflation hedge and inflation is coming, and therefore the stock market will do well. But I kind of look at this chart and see that the Nasdaq dropped 80% off of its highs, while the Russell and S&P corrected a much more modest 30 some odd percent. And what I'm thinking in this time around, what if we don't have a bear market on the primary stocks, and stocks do what many people anticipate as being an inflation hedge, but that doesn't mean that these bubbles sectors in the market won't have a very deep mean reversion. This overshoot that's happening in this space can still have many of those stocks in those sectors wipe out 50% on the downside, and us still on the broader equity indices see the market doing just fine. It's a really interesting moment in the markets where these parabolic rises can't last forever. Otherwise, these companies will all within months be multi-trillion-dollar companies. And so really what it comes down to is what will it look like in a period where they finally exhaust themselves to the upside and mean revert. And that's probably one of the more interesting things we're probably going to see in 2021. And trying to solve the puzzle piece as to when it begins is going to be really interesting.
Patrick, let's move on to page 6. Boy, you can see the 200-day really looks like that's what's filling in and holding the gold market up. Do you think it breaks and we test that lower support zone, or do you think that this is going to hold?
Well, it's interesting because Luke Gromen was just talking about the idea that 5% or so on the downside potentially of gold, and it's interesting that that's a level that lines up with the consolidation from April to June, where there's some high volume nodes that create that consolidation. And if we broke the 200-day moving average, that's that 5% downside probably that Luke was referencing to. And I think that's the single biggest thing to watch here is that was this simply just a short-term correction that comes to the support line, like back in during the March crash, and once again in the sell-off in November. Each time the area or zone around the 200-day moving average did mark the low of for a swing low of gold, and then gold turned and rallied from there. And watching whether this time around acts as a support is also one of these really important moments, because either this is an extraordinary buy on dip, or there's going to be a lot of technicians that are going to have the red flag waving as 200-day moving average is broken, which for many traders is a sign that the bull market may have exhausted itself, and maybe spur on some liquidity selling in the gold. I personally remain optimistic on gold, but it's a very critical moment technically.
Well, and I think the thing that would get you that breakdown below the 200-day would be if we continue to see real yields, at least in the immediate term, continuing to trend higher. That's gold's biggest enemy. And it's amazing to me that people can't see the forest for the trees and recognize that it's not likely to end very long. But frankly, it's fine with me if we get a big dip down to, looks like this support zone bottoms out around 1680 or so. Maybe we go even deeper than that on a break below the 200-day. There's a chance to buy more gold as far as I'm concerned, because I know at the end of the day, or the end of the decade, as the case may be, I've got Janet Yellen and Jay Powell on Team Fed and Treasury in order to make sure that the government prints enough money to debase the dollar and make that gold worth more. So I'm just not worried about it long term. But I could easily see if we did have this continued trend of real yields trending higher, that it could take gold lower. In any event, Patrick, let's move on to broader commodity indices on page 7.
Really, what I was just trying to capture here is just that this impulse higher in oil is not the only commodity that's hot. And I'm sure many traders and listeners have already been tracking it, but it's a very broad commodity rally at this stage. I have here corn and soybean and copper and iron ore, but there's no shortage of these commodities that are all up and have more or less been in a pretty decisive uptrend, particularly many just just beginning to accelerate in November on the upside. And this has been a very hot sector. There's a whole array of these commodity stocks that are just doing extraordinarily well, and then just continuing to feed more and more sectors that are doing these almost parabolic rises on the upside. And this is obviously feeding the reflation trade, weak dollar, rising commodities, and kind of creating that feedback loop. And it's really going to be interesting to see how long these trends can still continue through January.
Moving on to page 8, let's take a look at the 10-year Treasury yield. Boy, Patrick, we're talking about 10-year yields over 1% as if that were a big number. It's amazing how times have changed. But as I look at what's happening here, it seems like the bottom of that green box that you have would be the logical target for maybe where this goes before it reverses.
Right. And I mean, there's a lot of people asking that question as to, how high can yields go before the stock market starts to care? And, where is it that we start seeing yield curve control messaging coming from the Fed? And what I kind of look at is like, really, almost all of the markets have started to return back to their post-coronavirus levels. And it's like, is it really out of line for Treasury yields to come back to 1.5%, a level they were trading at just a year ago? I mean, is that really a crisis? I still think there's plenty of room for bond yields to go without it actually causing a lot of havoc in the markets. But the one interesting thing, and I think it's the one way to perceive it, is that I think that as so long as yields are slowly crawling higher, the market won't react to it. But I think that if we continue to see very rapid jumps in yields and the rate of change of the yield starts to accelerate, I think that would be what would make the market nervous. And so I think it's just the way it does this rise that will be far more important than the actual level. And I think that's going to be really interesting to see what really was triggered when this 1% was broken out over the last week.
And moving on to page 9, boy, take a look at that 2s10s yield curve. Remember Charlie McElligot's words of fear the steepener. Looks like the steepener's coming straight on at us.
Yeah, and it doesn't seem like anyone's scared of it, is it? But I mean, we did have an inverted curve back in 2019, and really this is now turned up. And we did a long-term chart going all the way back to 1990s just to kind of look at the last few times we've seen the steepeners kicking in, and asking the question, have we seen the beginning of a sustained rise in the steepener? And it really does look like a legitimate roll-up and a potential beginning of a rise. And it'll be really interesting to see, I mean, if with the front of the curve being pinned at this stage, the bear steepener, even if we saw the 10-year yield getting back towards like that 1.5% that we were just talking about, I mean, we could get right back into 2011, 2013 ranges on the steepener. So it's definitely going to be really interesting to see. And it's certainly been the tailwind for a lot of securities that benefit from these wider spreads. And so it's definitely the thing to watch. But what I wanted to really highlight on page 10, though, is those inflation expectations, like your 30-year break-evens on it. And they're really starting to slowly break out on the upside. And I think that this is where we want to really be watching, because if we start seeing that these inflation expectations really start to spike, I think that that's what's going to make a lot of investors and traders nervous about this move.
Well, I mean, just look at it. This huge downtrend in inflation expectations. It bottoms on a crisis where there's a huge stimulus expectation that could easily provide the fundamental impetus for a secular reversal of trend. And so far, the very first step to see if that's going to come true is to get to the short-term previous peak, which was, back at the beginning of 2020. We're already above that one. We're just barely flirting with the 2019 high right now. And if we break above that, the next test is the 2018 high. And if we get above that, boy, it's hard to say that we don't have a secular trend reversal in terms of inflation expectations. And of course, inflation expectations drive inflation. Let's move on to junk bonds on page 11. What's going on here, Patrick?
I find it really interesting that junk bonds haven't got the memo that the rest of the bond market is selling. And obviously, junk bonds tend to have a strong correlation with equities, just the nature of what we've seen in the past. But what we continue to see is that treasury bonds are selling, which is the blue line over there. And even we started to see the investment grade corporates start to get very heavy and roll over. But the junk bond market continues to be very quiet and holding up along its highs. And I think one of the more interesting things, like when we look at the corporate bond options adjusted credit spreads on page 12, you can see that we continue to hover both on investment grade and high yield very close to, the decade lows or multi-year lows, definitely. And the question is that at what point do these corporate bonds start to price in some sort of risk? And, there's potentially with the continuation of this coronavirus, there has to be some potential risk of increased defaults on some of these periphery companies. And clearly, this credit spread is not pricing in much worry at all. It's going to be really interesting to see when we see the junk bond market start to turn a little bit. It certainly is not showing any sign of that now.
No, it sure isn't. And it's tempting to say, okay, there's a trade there. But boy, how many times in the last few years have we looked at junk bonds and scratched our head and just said, boy, they're not pricing in the risk. But that didn't change. You don't really want to bet against it until you can see it actually start to move. Moving on to page 13, of course, you can get a free trial to Big Picture Trading and get Patrick's chart books, not just once a week, but almost every single day, 4 days a week. Information is there on page 13. We're going to leave it there for this week's show. This episode is brought to you by Abax Technologies, pioneering the design of smarter markets that better meet the needs of both market participants and society as a whole. Patrick, what can they expect to find in this week's Research Roundup?
Today, you're going to find the transcript for today's interview, as well as a link to the chart book we just discussed in the postgame. There's also an oilprice.com article on Exxon's mega oil find and a link to the Variant Perception article on sweep elections and sector mean reversions. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all of the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend, and that's Erik spelt with a K, and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.